Hello and welcome everyone to the Tribal Group full year results 2023. Let me start, if I may, just to remind us who we are. So Tribal Group empowers the world of education through our software services and products. We provide innovative solutions to our customers as we move ourselves to become a software as a service, as a full service model provider. A reminder also of our market share. Within the UK, some 65%, nearly two-thirds of higher education universities are our customers. In Australia and New Zealand, we have around about a quarter of the universities as our customers. We have a strong market share also within further education, with about 35% or so. And within that customer base, we drive our key metric of annual recurring revenue, ARR, which 2023 reached its high point so far of £54.5 million. It's also a reminder that we have an important second other business, education services, which provides educational services to the school sector as well as to further education and to universities. So to the 2023 results. 2023 really demonstrated the resilience of Tribal. I think in the face of some distractions, we had a solid trading performance. We had a solid sales performance with new customers, with existing customers moving into the cloud, which is a key strategic initiative of Tribal. We saw our annual recurring revenue increasing 9%. We saw our revenue up, our adjusted EBITDA up, and our net debt ahead of previous market expectations. We also were focused on a number of key initiatives, particularly around restructuring the business as we move to that SaaS full service model approach. We also reduced the cost base in the business. We moved our education services to be a standalone business. And also we are taking steps to resolve our dispute with Nanyang Technological University, NTU, which is progressing. Mediation has now been invoked. That mediation process will have concluded by the end of H1. So let's look at what is driving our business. The student management system challenge for universities is very much around having had a student management system for many, many years. And within those years, you drive complexity, inefficiency, often over some 10 or 15 years of investment in SITs. Universities often lack the resource and skills to be able to modernize their system, and also improving the student experience as a competitive advantage is key. Many students look at the experience they get from a university as part of their selection criteria for which university they go to. And all of that provides opportunities for Tribal. The current status for the higher education sector, particularly in the UK, is really about a growing funding crisis as there's been a significant increase in cost base, a real terms reduction from the domestic students who continue to pay the 9,250 fee as they have done for many years. In real terms, that revenue goes down. And more recently, they've been hit by a reduction in international students coming into the UK, largely as a result of the UK immigration policy. So there's a lot more competition around universities looking for international students who they can charge whatever they wish to international students, and that will then drive that revenue up for the universities. So the universities have a challenge. Actually, what does that mean for Tribal? It actually means that universities are very much looking at technology as a way of reducing the cost base, looking at technology in a way of helping them drive more international students to the university. And we are in the process of developing our Tribal admissions product, which we feel will be very well received in the sector as it helps universities deal with exactly that issue and will enable them to compete very effectively against other universities to attract international students. That will be available coming in 2025 for our universities. So a reminder of our growth strategy around three pillars. The first is around the expanded share of wallet, and there are many opportunities within this first pillar. So the universities, as they transition many into the cloud, and that provides an opportunity to drive our ARR, but also in terms of the improvement customers want to make, or the modernization to their core product provides also opportunities. Expanding the addressable market is about bringing new products such as admissions and other new products that we have successfully launched into our customer base. And thirdly, it is about expanding geographically, although at the moment that is on hold, and we're really focusing on how we expand our customer share of wallet. I thought it might be useful then to discuss two particular opportunities that we have closed in 2023 relating to how we are driving increased ARR from our existing customer base. And these are two large universities, both of whom are addressing complexity within their existing product and how they can move and take advantage of the cloud. In the first example, a large Russell Group university in the West Country had a huge, complex migration into the cloud of the existing SITS application. That took something like 8 months or so to complete, but it drove more than 650,000 of ARR increase, simply that move into the cloud, and approaching £1 million worth of professional services revenue. So each of these cloud migrations is a very significant project, a significant investment by the customer, and a really significant win for us. We've talked in the past about the ARR increase and used really as a reference point the support and maintenance they're paying at the moment, and that the increase could be 2.5 to 3 times what they are paying at the moment in ARR in support and maintenance. Actually, in this particular example, it was up to more than 4 times. So they started with a support and maintenance of just over £200,000. We now, with that existing support and maintenance and the ARR increase moving into the cloud, move that up to the best part of £900,000. And that's a single customer boom, 200 to 900. The other customer, a large Welsh customer, will go into the cloud at a point in the future, but they chose to optimize their SITS product. They really liked the SITS product, but they've had it implemented for 15 or more years. And over that time, it's built up complexities and needed really to be modernized. So they have chosen to re-implement SITS on-premise before they then make a decision at some point in the future to go to the cloud. So the on-premise re-implementation was a significant part of the professional services revenue, £1.4 million to re-implement. And it was also an opportunity to upsell some various cloud products. So the ARR increase from that university was 160,000 or so, more than doubling the ARR. It took 10 months or so to close the deal, but it's an interesting one because it's the first full re-implementation of SITS that we've had. And I think what it shows is that for the existing customer base, there are a number of areas where we can drive additional revenue. One is in the move from on-premise into the cloud, so the technology infrastructure improvement. The second is around how we can work to optimize the SITS product functionally itself. That's a significant revenue opportunity. And indeed then upselling other opportunities as a third opportunity into the existing customer base. So we still look clearly to win new customers, but actually the revenue increase is not reliant on the new customers because there is a lot of opportunity within our existing customer base. To that end, we had some significant new wins in the year. So we had 4 customers who moved into the cloud, and that brings the total to approaching 35 customers. But actually, there are some 70 plus customers still to go to look to move into the cloud. And we estimate that there is £20 million plus of opportunity within that customer base simply to move those customers into the cloud. So still a huge amount of opportunity within our existing customer base. We did, though, win one new customer, the London School of Science and Technology, as well as our other capabilities and products that we won new customers also. And it's also important to point out education services had a good year in terms of renewing existing contracts and also winning some new ones. Perhaps the one to pull out particularly here is the one that says the Musk Schools at the bottom, which is a small contract within Saudi Arabia, of itself not significant, but it gave us the opportunity to get our foot in the door, set ourselves up in Saudi Arabia, which positions us for the investment that the Kingdom of Saudi Arabia is expected to make in their education system, as a very large investment, of which part of that we would expect to be opportunities that we could tender for. There's no timeline set. It will happen when it happens, but it's looking increasingly like there will be a significant investment at some point, and we feel we are well positioned to tender effectively for those opportunities when they come. So with that, I will pass you over to Diane to take you through the numbers. Diane.
Thank you very much, Mark. So overall, our results have recovered since the prior year, and our underlying business performance remains strong. So to start with a summary of our key financial metrics, revenue grew 3.2% to 85.7 million. ARR has solid growth of 8.7% to 54.5 million, driven by a strong 13% growth in our core products through both cloud and foundation, offset by the expected decline in our non-core areas. And committed income or order backlog is down 0.9% to 168.8 million due to the delivery of large contracts across both ES and SIS. Adjusted EBITDA has almost doubled to 14.4 million, mostly due to the 2022 numbers being impacted by the creation of the 4.5 million onerous contract provision. In 2023, the net impact of the provision release, offset by associated NTU costs, was a one-off benefit of 0.6 million. This increase in EBITDA flows through to a higher statutory profit before tax of 6.6 million and a statutory basic earnings per share of 2.5p. Within the year, there were 3.3 million of exceptional charges, which includes 1.4 million relating to the lapsed offer by Lucian, 1 million relating to the restructure of the ES business, and 1 million due to SIS redundancies. ES exceptional charges are due to its move to a standalone entity within the group, with its very own legal company structure. The SIS redundancies, which took place in early 2024, are part of a transition to an EdTech SaaS business, and as we are now reducing from the peak of our Edge investment. Net debt increased to 7.2 million. Cash flow was impacted from NTU project costs in the first quarter of the year and the cash impact from exceptionals in the second half. Capitalised product development is down 17% to 8.5 million as we near the launch of our Edge admission product, and investment is now falling from its peak in 2022. With the increase in EBITDA and decrease in CapEx, our cash EBITDA number has jumped from a negative 3.1 to a positive 5.9 million. My second slide shows the performance of our two business units, Student Information Systems and Education Services. SIS will be discussed in more detail later, but in summary, revenue has increased by 0.7 million to 68.6 million, as sales growth in our cloud and foundation products are offset by a 1.2 million revenue impact from the loss of the NTU contract. Operating margin has increased to 37.5%, with an underlying operating margin of circa 35%, given that net impact of the owner's contract provision release. On the ES side, we have seen the business continuing to grow strongly, with revenue growing 12.7%. School inspections are tracking well, with revenue increases driven by contracts within the Department for Education in England. Our NCETM contract scope was increased, which is the National Centre for Excellence in the Teaching of Mathematics, and that resulted in additional revenues. and the contract for the National Tutoring Programme, won in 2022, benefited from a full year's delivery. The decrease in operating margin is largely due to the mix of contracts, lower revenues in the Middle East, which typically attract higher margins, together with investment in the delivery, sales, and management teams to drive future growth. There were 0.6 million of one-off costs within EBITDA, the majority of which relate to the reorganisation of the operating model. Therefore, the underlying margin is 17.4%. This means our overall segment operating margin has increased from 18.1 to 28.1 million. The next slide moves on to cover our SIS performance. Overall, as mentioned, revenues have increased 1.1%, with new contracts and uplifts across our foundation and cloud products, offset with the 1.2 million negative impact from the closure of the NTU contract, and also declines in our other software and services. Operating margin has been positively impacted by 1.8 million due to the release of the NTU onerous contract provision, offset with associated costs. Therefore, the underlying margin is stable at circa 35%. At a total group level, the one-off benefit is only 0.6 million due to costs within central overheads. Please note that due to the level of uncertainty, no provision for future NTU costs have been made. As we transition to a subscription service-led model, as Mark was talking about earlier, we continue to experience headwinds from our legacy product lines. We've implemented a cost reduction program in 2024 to ensure our operating margins remain stable. So going through our standard SaaS metrics at the bottom left, they show a stable gross and net revenue retention. GRR demonstrates that of the customer base as at December 2022, 9% of the recurring revenues have been lost through customer downgrades or cancellations. But then when you include upsells to the same customer base, recurring revenues increase to give a net revenue retention of 102%. Underlying performance is still strong, as the decline is driven by a 4.9 percentage point movement from NTU and the drop in the Australian DOE contract within other software and services. So moving to the table at the top, you can see core revenues increasing by 1.6 million. We had strong growth in cloud and foundation software. Cloud has benefited from our 4 cloud migration sales this year and 5 in the previous year, and foundation software has increased with new sales across all of our product lines. Professional services declined by 1.9 million due to the impact of NTU and slower sales caused by the disruption of the Ellucian offer. Other software and services continue to decline, with reductions in our DOE contract and Schools Edge churn. Our TAFE New South Wales contract was extended from H2 2023 to H2 2024, at which point we anticipate no further revenue will be generated. The TAFE and DOE contracts together contributed 4.9 million to other software and services revenue in 2023. On the next slide, we look at SIS ARR in more detail. Overall ARR has grown 8.7% to 54.5 million. As a reminder, ARR is a forward-looking indicator of recurring SaaS revenues for the next 12 months. In the bottom left-hand chart, you can see our growth areas have increased 25%, offset by declines in our other software and services products. Looking at it in more detail at the table at the top left, you can see 2.6% growth in foundation support and maintenance, foundation software increasing 43%, with a SITS win that Mark mentioned earlier, the London School of Science and Technology, and uplifts across the base. Cloud services grew 25%, mainly from the 4 existing customer migrations: Exeter, Royal Vet College, University of Arts London, and University of Wolverhampton. The growth in our core products is offset by the expected decline in other software and services, which have declined 31% due to the expected completion in June 2024 of the Australian DOE contract. There is 1 remaining large government contract left in other software and services, which has an associated £1 million of ARR and is expected to end in June 2025 and will therefore be removed from ARR in June 2024. In summary, the continuing growth in core ARR, especially in the cloud, gives us a very solid foundation for future cross-sell to existing customers. The next slide moves on to cash flow. Our net debt position has increased from 3.4 million to 7.2 million at the year end. 9.4 million of cash was generated from operating activities before tax. This number includes 3.7 million of cash outflows in association with the NGU contract, 1.7 million of cash exceptionals, but also a positive underlying working capital performance, as seen by our 111% cash conversion ratio. Tax payments and other items, mainly property leases, were 2.3 million, and investment continues in our edge products, albeit at a lower rate, at 8.5 million. With the financing, forex and dividend cash outflow added, it brings us to our year-end net debt position of 7.2 million. At the end of 2023, we renewed our bank facilities and now have a £20 million revolving credit facility with HSBC and a further £5 million accordion. Loan facilities run until the end of 2026 with 2 additional optional years, and we also have a £2 million overdraft facility in the UK and a $2 million Australian dollar facility. My next slide is on product development. Our capitalised product development spend has decreased to 8.5 million as we focus our efforts on our existing successful edge product range and completing admissions in order to maximise our returns. A continuing trend of reductions is expected in 2024. In summary, the financials show a steady growth of high-quality recurring revenue streams. The growth in our core ARR is outpacing the impact from our legacy products, and with our reducing CapEx and cost reduction programs, we aim to maintain margins and improve cash flow over time as we transition to our EdTech SaaS business. As Mark was saying, only 32 of our 127 SITS customers have moved to the cloud, so there's still a significant opportunity for us to grow ARR. I'll now hand back to Mark, who will talk more about our outlook for 2024. Over to you, Mark.
Thank you very much, Diane. So I want to comment on some of our key initiatives that we have been running, particularly the 3 there, starting with the transition to a software as a service or a full service and partnership model. This is a key change to enable us to move to a true SaaS business and is a significant change to the business as well as a significant change to our customers. So internally within the business, we have been making changes, restructuring the business to move to that more service model. That includes investing in a customer success team, but at the same time reducing costs elsewhere in the business. And that also informs our operational efficiency initiative, which is really about becoming a more efficient organization, restructuring the organization such that internally we have more standardized, simplified processes that we manage globally from an offshore team, which we successfully started in 2023. We've migrated a significant part of the finance transactions out to that team and will continue that program through 2024. It's also about amalgamating teams together to drive greater efficiency from a single team, to move away from a more siloed approach, and the fusion of our edge and our student management system investment into a single investment drives better solutions for customers, but it also maximizes the benefit we get out of our investment decisions. But also we have a core cost reduction program about making sure we are maintaining our margins, driving our margins as we transition by taking out cost. A third initiative is around our education services business moving to be a standalone business. So we have previously reported that we have been considering the strategic options for the education services business, and this remains the case. But it was also clear that the business would benefit from being truly standalone. It would reduce the sale risk if we were to divest the business, and carving it out of the core business would be a challenge. Having done that in advance puts it in that better position. It also enables the business to demonstrate its standalone value rather than any reliance on the core part of our business. So carving it out as a standalone business It has been work in 2023. It continues in 2024. And as a business, we are investing in it. We believe there are strong growth opportunities, for example, in Saudi Arabia, as I've outlined, but also in the US and indeed in the UK itself. And we will continue to invest, and we'll see the benefits of that over the coming couple of years or so. And we will, after that, then consider our strategic options for the business. So if we move on to just the summary, I think the strength, the resilience of the business is demonstrated by these results and the fact of the stickiness of our customers. We have a strong business model, as we've seen by that steady growth in ARR, and we expect to continue to see that growth as we migrate more customers into the cloud, and that large opportunity remains. Clearly, we're focused on resolving the challenges around NTU. And so far this year, we've been trading in line with the board expectations. We need to ramp up our sales opportunities, build back that momentum following the closure of the Ellucian bid. But the universities remain focused on moving to the cloud. And as we've seen, the requirement for them to embrace innovative technology solutions in order to drive their top line and manage their cost base remains as strong as ever. So overall, our trading outlook remains positive.